Hey, Ken AG here. Silver is sitting at 82.81 as I record this video, but that number is irrelevant, completely irrelevant, and by the end of this video you'll understand why. Because there's a different number buried inside the COMEX vault reports that nobody on financial television is talking about. A number that doesn't whisper. It confesses. And when you put that number next to the calendar, specifically February 27th, you get a question that the entire silver market will have to answer in the next 8 trading days. That question is simple. It's the same question that has broken every fractional system in human history. Are you delivering, or are you paying people to look the other way? I'm going to walk you through the math, step by step. No hype, no cult. And at the end, I'm going to show you one specific data point, something most analysts are completely ignoring, that changes the entire picture. Stay till the end for that one because it reframes everything. Quick disclaimer first. Nothing in this video is financial advice. I'm not telling you to buy, sell, or hold anything. I'm walking through publicly available exchange data and doing arithmetic. All right, I want you to think about a hotel. Not a fancy one, just a regular hotel with 100 rooms. Now imagine that hotel sold 270 reservations for the same night. They did this because historically, about 60% of people cancel or don't show up. So selling 270 reservations for 100 rooms usually works. The math is in your favor. Most nights, you end up with maybe 90 guests and 10 empty rooms. But before I show you the numbers, you need to understand one thing. Because this one detail is what separates people who panic from people who profit. The COMEX has 2 categories of silver: total inventory and registered inventory. Total is everything in the vault. Registered is the metal with warrants issued, the metal that's actually sitting on the delivery counter, available to fulfill a futures contract. Most people quote total inventory because it's a bigger, more comforting number. I don't. I quote registered, because registered is the only number that matters when someone says, "Give me my silver." And that number is falling. 88.79 million ounces. Down 3.36 million recently, not crashing, falling, steadily, persistently, and in one direction. Metal leaves the registered category and does not come back at the same pace. This is not an opinion. It's the daily vault report. Now here's the other number. March contract open interest, converted into ounces, is in the range of 240 million ounces. 240 million ounces of potential delivery demand against 88 million ounces of deliverable metal. The ratio is roughly 2.7 to 1, and that gap, that 150 million ounce hole, only exists because of a single assumption. The same assumption the hotel makes. Most of them will roll. Most of them will cancel. Most of them won't actually show up and demand the room. And historically, that assumption is correct. In normal delivery months, only 2 to 5% of contracts stand for physical delivery. The rest get rolled into the next month or closed out for cash. The system is designed around this behavior. It depends on it. The COMEX is not built to deliver silver to everyone who has a contract. It's built to deliver silver to the small percentage who insist. But here's where the math gets uncomfortable. Even at the low end, even if only 5% stand for delivery, that's 12 million ounces. Manageable. The system breeds. But if that number creeps up to 10%, you're looking at 24 million ounces. That's more than a quarter of registered inventory gone in a single delivery cycle. And if it hits 15%, which has happened in stressed environments, you're draining more than a third of available metal. And the metal that leaves doesn't teleport back into the vault the next morning. Once it's delivered, it's gone. The next delivery month starts with whatever is left, which means March isn't just a standalone event, it's the first domino. As March drains 25 or 30 million ounces, April starts the game with less inventory and the same structural pressures. The system doesn't die in the headline, it dies in the sequence. Now, here's where it gets really interesting. Because there's a mechanism inside this market that will determine whether March passes quietly or becomes a headline. And almost nobody outside the institutional trading desks understands how it works. It's called the roll rate. As we approach First Notice Day, which is the date when contract holders must declare whether they're taking delivery or rolling forward, you can track how fast open interest declines. That decline tells you how many people are choosing to leave versus how many are choosing to stay. The target pace right now is roughly 30 million ounces per day rolling off. If that pace holds or accelerates, the system gets through March without drama. Open interest deflates in time. Delivery demands stay within the registered inventory cushion. The hotel has enough rooms. But if the roll rate slows, if fewer people are canceling their reservations than expected, then the gap between potential demand and available supply doesn't close fast enough. And on First Notice Day, whoever is left standing is standing for metal. This is not prophecy, it's a condition. If A happens, the market passes quietly. If B happens, the market passes with tension. And tension in a commodity market doesn't need to become a default to become consequential. Tension becomes premium. Tension becomes delay. Tension becomes restricted availability and urgency pricing. You don't need the hotel to burn down. You just need more guests than rooms on a single night. And here's the subtlety that separates analysis from hype. March might not even be the real bottleneck. The real bottleneck might be what comes after. Because if the system barely squeezes through March, it comes out the other side with worse inventory, less cushion, less margin for error, and April becomes the next wall. Then May, then June. Each delivery month starts with whatever the previous month left behind. And if each month leaves behind less than it started with, the trend compounds. The hotel doesn't run out of rooms on the first overbooked night. It runs out on the third or fourth consecutive overbooked night, when the maintenance staff hasn't had time to clean the rooms from the previous wave. This is why I track registered inventory not as a snapshot, but as a trend line. A single number on a single day is meaningless, but a direction, sustained over weeks and months, tells you everything about the structural health of the delivery system. And the direction has been down, consistently, persistently, without meaningful reversal. But there's a detail from February that most people missed entirely, and it's a psychological signal that changes the tone of everything I just told you. Approximately 200 February contracts remained open past their expected roll date. In the industry, we call these sticky contracts. In a normal market, this resolves without anyone noticing. Contracts close, positions settle, life goes on. But when sticky contracts become a topic of discussion, it's because the friction increased. People didn't roll because they didn't want to roll. They wanted the metal, or they wanted to test whether the metal was there. That's a psychological signal, not just a mechanical one. When it gets hard to close your position, it's usually because someone on the other side wants what you're holding. And in a delivery market, what you're holding is a claim on physical silver. Now let me address the narrative that dominated social media this week. China was on holiday through the 24th. Half of Twitter was certain this meant a coordinated slam in silver prices. The logic was simple. Reduced liquidity from the Asian session creates a window for concentrated selling. Thin markets are easier to move. The slam was guaranteed. Except it didn't happen. Silver opened the week around 75.34. As I record this, it's sitting at 82.49. The guaranteed punch never landed. Does that mean it can't still happen? No. Low liquidity windows remain open. But it does mean the consensus certainty was just consensus certainty. And consensus certainty, in my experience, is wrong more often than a coin flip. When everybody expects the punch and the punch doesn't come, that itself is data. It tells you the selling pressure that was supposed to appear either doesn't exist at the scale people assumed or is being absorbed by buying pressure that nobody is talking about. And that brings us to the part of this video that I've been building toward. Because there's a price signal coming out of Asia right now that, if you understand what it means, reframes this entire analysis, and it's hiding in plain sight. Shanghai. As of my last check, Chinese spot silver is trading around $86. Shanghai futures near 88. That's a $4 premium over Western markets. And I need you to understand what that premium means in structural terms. It means buyers in the world's largest industrial economy are paying more than the benchmark says silver costs. Not because they're irrational, not because they're caught up in hype, because they need the metal and they can't get it at the Western price. Shanghai operates with a physical delivery bias. When industrial users buy on the Shanghai Futures Exchange or the Shanghai Gold Exchange, they expect bars to arrive at their facility. They're going to melt that silver and turn it into solar panels, batteries, and electronics. Physical settlement is the norm, not the exception. So when Shanghai prices persistently run above COMEX, it's not a quirk. It's the physical market telling the paper market that the screen price is insufficient. And that premium has been stubborn. It hasn't closed. It hasn't converged. It's sitting there week after week like a check engine light that won't turn off. And when China returns from holiday on the 24th with pent-up demand and a delivery backlog, that premium could widen before it narrows, which adds pressure to the exact same inventory pool we've been tracking. Now, if all of this wasn't enough, the macro picture just made everything worse. And I mean measurably worse, not opinion worse, data worse. Now, zoom out to macro for 30 seconds because it matters. The latest GDP print came in at 1.4% versus 3% expectations. Final sales even weaker at 1.2%. Core PCE at 3% above projections. In plain language, the economy is slowing while inflation refuses to cooperate. That combination has a name: stagflation. And stagflation is the one environment where central banks lose their relief valve. They can't cut rates aggressively because inflation is sticky. They can't raise rates because growth is already fragile. They're stuck. And when the central bank loses freedom of movement, real assets gain relevance. Not because of sentiment, because of math. When real yields are negative or flat, the opportunity cost of holding a non-yielding asset like silver drops to zero. Silver stops being an alternative, and then layer in geopolitics. The largest military presence in the Middle East since 2003. Market-implied odds of a strike through March 31st sitting at 61%. This doesn't require a war. It requires a probability. Because probability moves energy prices. Energy moves inflation. Inflation moves real yields. And real yields feed back into metals. The loop is self-reinforcing. Each variable amplifies the next. You don't need the bomb to drop. You need the market to price in the chance that it might. And at 61% implied probability, the market is pricing exactly that. That risk premium doesn't appear in the silver spot price directly, but it shows up in hedging behavior, in options pricing, in the urgency with which industrial users secure forward supply. It's the invisible hand pushing everyone to act a little sooner, buy a little more, hold a little tighter. And all of that tightness converges on the same limited pool of registered metal. So let me bring this together. Because the value of this analysis isn't any single data point. It's the convergence. Registered inventory is draining. The direction is clear and the pace hasn't reversed. March open interest creates a 2.7 to 1 mismatch against deliverable metal. The roll rate will determine whether that gap closes in time or becomes a delivery squeeze. Sticky February contracts suggest appetite for physical is increasing, not decreasing. The China holiday slam narrative failed to materialize, indicating underlying bid strength. Shanghai premiums persist, signaling that the physical market is pricing silver higher than the paper market. Macro has deteriorated into a stagflationary mix that favors real assets, and geopolitical risk has a calendar and a probability. Individually, each of these is manageable. Collectively, they describe a system operating at the edge of its design tolerance, not past the edge, at the edge. And systems that operate at the edge don't need a catastrophic event to malfunction. They need a slightly above average demand day. They need the conference and the hurricane on the same weekend. They need 5% to become 8% on a single delivery notice. I've studied enough commodity squeezes to know that the breaking point never looks dramatic in advance. The nickel squeeze on the LME in 2022 looked like a normal market the day before it went vertical. Traders were going about their business. Open interest was elevated but not alarming. Inventory was tight but functional. And then one participant couldn't deliver. Just one. And the cascade started. Prices went vertical in hours. The exchange suspended trading. Transactions were canceled retroactively. The rules of the game changed mid-game. That wasn't a conspiracy. It was physics. The system was designed for normal conditions. It encountered abnormal conditions. And the gap between design and reality was settled in volatility. Now, remember at the beginning I told you there was one specific data point that reframes everything. Here it is. Watch the ratio of delivery notices in the first 3 days of March relative to registered inventory. Not the total month, the first 3 days. Because in every historical delivery squeeze, the front-loading of notices is the tell. When longs are serious about taking metal, they don't wait until day 15. They file on day 1. If March delivery notices in the first 72 hours exceed 10% of registered inventory, the remaining 20 days of the month become a pressure cooker with no relief valve. That's your early warning system. That's the number I'll be watching before anything else. And I'll report it here the moment it prints. The question is not whether there will be a COMEX default. That's the dramatic framing that makes for good thumbnails but bad analysis. The real question is quieter and more consequential. Between now and April, does enough metal flow in to rebuild the cushion, or does the system have to buy time again? Because buying time is not free. It costs premium. It costs credibility. And eventually, it costs the assumption that the system works as advertised. Watch the registered inventory every day. Not the headlines, not the tweets, the vault report. Because headlines are foam. Inventory is the tide. If this video helped you understand what's actually happening inside the COMEX delivery structure and why the next 8 trading days matter, hit the like button. It costs you nothing, and it pushes this kind of analysis past the algorithm to reach people who need data, not drama. Leave a comment below. Tell me what you're watching, the roll rate, registered inventory, Shanghai premium, or the macro picture. I read every comment, and your input shapes what we cover next. If you're not subscribed, hit subscribe and turn on the bell. We'll be tracking the daily vault reports and roll rate in real time as we head into first notice day. You do not want to miss that coverage. Share this with someone who's trying to understand what COMEX delivery mechanics actually mean. Let the numbers speak.